Hello, friends. Welcome to Money Mosaic.
Have you noticed the biggest question running through the minds of almost every individual in India today? Is it safer to keep our hard-earned money locked in a bank fixed deposit, FD? Or can we build massive wealth over the long term by investing every month through a mutual fund systematic investment plan? The biggest doubt most people have is that FDs offer guaranteed returns with zero risk to our principal capital. At the same time, when people hear about SIPs, there is an immediate fear of market volatility and potential losses. But what does the actual 20-year historical data reveal about who the true winner is? After beating inflation and deducting taxes, what is the exact net return that actually reaches our hands? Let's analyze all this data clearly and simply in today's video. Along with this, we will also discuss the current market scenario, the impact of crude oil prices, global macroeconomic developments, and the latest updates on our IT and pharma stocks in detail before concluding today's market analysis. First, let's try to understand this 20-year SIP versus FD comparison step by step. Let's assume an average salaried employee or retail investor invests $10,000 every month consistently over a 20-year period. What would be the total principal amount genuinely invested out of your pocket over these 20 years? It comes out to exactly 24 lakh rupees. Now let's first look at bank fixed deposits, FDs. Over the last 20 years in India, what have average FD interest rates looked like? At one point, rates were around 8% or 8.5%, but over time they gradually declined to a range of 6 to 6.5%. Even if we assume a fairly generous average compounded annual return of 7% for an FD, your invested capital of 24 lakhs grows to a total corpus of approximately 52 lakhs after 20 years. So, what is your net profit? 28 lakhs. On paper, this sounds great, right? You put in 24 lakhs and got 52 lakhs back, more than double your original amount. But here is where the main twist lies. What most people completely forget or fail to account for are inflation and taxation. What is the average inflation rate in India? It averages between 5.5% and 6%. On top of that, interest earned from FDs is taxed according to your individual income tax slab. If you fall under the 20% or 30% tax bracket, around 1.5 to 2% of your 7% interest goes directly toward taxes. This leaves your real net yield at just 5% or 5.5. When inflation itself stands at 6%, what is the real purchasing power growth of your FD? It is essentially zero or even negative. So while you see 52 lakhs on paper, its real purchasing power 20 years later will barely beat the current value of your initial 24 lakhs. Now let's examine the second option, a mutual fund SIP. Suppose you invest that same $10,000 per month for 20 years into a well-diversified Nifty 50 index fund or a solid broad market equity mutual fund. Looking back at the last 20 years of Indian market history, the Nifty 50 index has delivered compounded annual returns averaging between 12% and 15%. Even if we take a conservative baseline return of just 12%, do you know what your 24 lakhs of invested capital grows into after 20 years? A staggering corpus of approximately 1.1 crore, 99.91 lakhs. If the fund you selected performs slightly better and delivers a 15% CAR, that corpus balloons to an astounding 1.51 crores. Did you observe the difference? While an FD yielded 52 lakhs, a conservative SEP generated over 1 crore. That represents almost double the wealth creation. Even after accounting for long-term capital gains LTCG tax, which stands at 12.5% on equity mutual funds beyond the initial 1.25 lakh exemption limit, your net post-tax profit remains between 85 lakhs and 1.3 crores. More importantly, your wealth grew in real terms by easily beating inflation. Apart from this, a common question many people ask is, "Brother, if the market crashes, won't I lose my SIP money?" But there is an essential principle to keep in mind. Over short time frames like 1 or 2 years, market fluctuations are completely natural. However, over a long-term horizon of 10 to 20 years, as the Indian economy expands, the equity market inevitably trends upward. When the market falls, your monthly SIP buys more units at lower prices. When the market rises, the overall valuation of those units surges. This process is called rupee cost averaging. Once you truly understand this concept, market dips will no longer cause panic, right? Moving beyond this personal finance comparison, let's take a look at the current overall market conditions. Over the past few trading sessions, crude oil prices have started surging once again. As crude oil moves toward the $90 to $95 per barrel range, pressure is clearly visible across Indian markets. Typically, rising crude prices spark inflation concerns, which in turn leads to sell-offs in equity markets. At the same time, ongoing geopolitical tensions between the U.S. and Iran in global markets continue to maintain a negative underlying sentiment. Fears regarding potential supply chain disruptions caused by warnings from regional actors like the Houthis in the Middle East are keeping the markets cautious. Efforts to restrict shipping routes around strategic maritime bottlenecks like the Strait of Hormuz and the Bab el-Mandeb are sending minor shockwaves through global energy markets. Additionally, recent policy announcements and statements from the U.S. regarding trade tariffs have added to short-term market volatility, particularly impacting our IT and pharma sectors. Threats of imposing higher tariffs on Indian pharmaceutical exports and generic drugs caused noticeable price movements in stocks like Lupin, Aurobindo Pharma, and Dr. Reddy's Laboratories. However, looking at the practical realities, India supplies over 40% of all generic medications consumed in the United States. Imposing heavy tariffs would drastically increase healthcare costs for American consumers, leading market analysts to view these statements largely as strategic political rhetoric. Turning to our IT sector, major players such as Infosys, TCS, and Accenture are navigating a transitional period. While artificial intelligence, AI, and semiconductor segments are experiencing strong momentum, traditional software services companies face temporary pressure due to tighter IT spending budgets among U.S. clients. Nevertheless, given that digital transformation remains an essential long-term necessity, the IT sector is expected to stabilize over time. Looking at our primary indices, Nifty and Bank Nifty have been consolidating within a tight range around the 24,000 level over the past 4 months. Persistent short positions maintained by foreign institutional investors, FIIs, have repeatedly triggered selling pressure whenever the market attempts an upward breakout. Conversely, consistent monthly inflows from domestic institutional investors, DIIs, and retail investors via SIPs continue to provide a solid floor for the market. On the downside, 23,800 to 23,600 serves as a crucial support zone for Nifty, while 24,300 and 24,600 act as primary overhead resistance levels. In individual stock updates, Barrett Forge partnering with a joint French-Canadian entity to manufacture heavy-lifting airships represents a notable positive development in the defense manufacturing space. Similarly, Paras Defense signing a Memorandum of Understanding, MOU, worth 6,200 crores to establish a semiconductor assembly and packaging facility in Madhya Pradesh marks a significant strategic expansion. Meanwhile, Zomato, Eternal, continues to demonstrate strong top-line revenue growth, fueled by its quick commerce division and Blinkit operations. In summary, the key takeaway from today's analysis is clear. Bank FDs serve well for maintaining an emergency fund or protecting short-term capital needs. However, if your objective is to build meaningful long-term wealth for retirement, children's education, or financial independence over a 10, 15, or 20-year horizon, disciplined monthly investing through mutual fund SIPs remains unmatched. If you found this breakdown valuable, please make sure to like the video and share it with your friends and family. Let us know in the comments section whether you currently prefer SIPs or FDs for your wealth journey. I will catch you again in another insightful financial video. Until then, take care and Jai Hind.